Are you tired of the financial noise? Drowning in a sea of conflicting advice, endless charts, and gurus promising untold riches if you just followed their secret system? Everywhere you look, it's another stock tip, another exotic crypto coin, another complex trading strategy touted as the next big thing. You open your investment app and are immediately hit with thousands of options, each screaming for your attention, leaving you feeling more confused than empowered. The sheer volume of information, the fear of making the wrong move, and the constant pressure to do something with your money can be utterly paralyzing. It feels like you need a degree in advanced economics just to build a decent portfolio, let alone understand it. This isn't just frustrating, it's designed to overwhelm you, to convince you that investing is an intricate game only the experts can win. But what if I told you that all this complexity is largely unnecessary? What if the very notion that more options, more active trading, and more intricate strategies lead to better returns is in fact one of the biggest myths in personal finance? For decades, the investment industry has thrived on this illusion, selling you complexity because complexity sells. They want you to believe that beating the market requires endless research, lightning-fast trades, and a crystal ball. They present investing as a high-stakes chess game against Wall Street's best and brightest, implying that without their sophisticated tools or high-fee services, you stand no chance. This narrative keeps you stressed, keeps you guessing, and most importantly, keeps your money flowing into their pockets. The truth is, chasing hot stocks, trying to time market swings, or constantly reshuffling your portfolio often leads to worse outcomes, not better ones. Academic studies and historical data consistently show that most active managers fail to beat simple, broad market benchmarks over the long run, especially after accounting for their higher fees and trading costs. The more you tinker, the more likely you are to introduce errors, incur unnecessary expenses, and ultimately undermine your own financial growth. It's time to debunk the myth that more complexity equals more profit. If you are actually getting value from this video, please kindly consider subscribing to this channel and also like and share the video. It helps us reach more audience and doesn't cost you a dime. So, how do we escape this cycle of overcomplication and underperformance? The answer lies in embracing a philosophy pioneered by an investing titan, John Bogle, the founder of Vanguard. Vanguard's core philosophy is refreshingly simple, almost revolutionary in its common sense. Keep costs low, diversify broadly, and stay the course. This isn't about chasing fleeting trends or trying to outsmart the market. It's about owning a piece of the entire market, letting the immense power of global capitalism work for you. Vanguard champions broad market indexing, a strategy where you invest in funds that track an entire index, like the S&P 500 or the total U.S. stock market, rather than trying to pick individual winners. This approach automatically diversifies your investments across hundreds, even thousands of companies, significantly reducing your risk compared to holding just a few individual stocks. But diversification is only half the battle. Vanguard also obsessively focuses on low costs. Every dollar saved in fees is a dollar that stays invested, compounding over decades into substantially larger sums. This relentless dedication to low-cost indexing means more of your money works for you, not for fund managers or brokers. It's a philosophy built on the bedrock of long-term thinking, discipline, and profound simplicity. In this video, I'm going to cut through all the noise, the fear, and the overwhelming options to show you something truly powerful. I'm going to reveal 3 Vanguard ETFs that, when combined, can form the bedrock of an incredibly robust, diversified, and remarkably simple investment portfolio. These aren't obscure, high-risk plays. They're battle-tested, low-cost vehicles designed for maximum efficiency and long-term growth. We're talking about a strategy that requires minimal ongoing management, frees up your precious time, and dramatically reduces your financial anxiety. Imagine a world where you don't need to check stock prices daily, agonize over market corrections, or sift through endless financial news. A world where your money is quietly working for you, building wealth steadily and reliably year after year. This isn't just about saving money on fees, it's about reclaiming your peace of mind and unlocking genuine long-term financial growth without the constant stress. This simplified solution empowers you to take control of your financial future, proving once and for all that less is truly more when it comes to investing your hard-earned money. Get ready to quit overcomplicating your portfolio because these 3 Vanguard ETFs are all you truly need. If you are actually getting value from this video, please kindly consider subscribing to this channel and also like and share the video. It helps us reach more audience and doesn't cost you a dime. So, how do we escape this cycle of overcomplication and underperformance? The answer lies in embracing a philosophy pioneered by an investing titan, John Bogle, the founder of Vanguard. Vanguard's core philosophy is refreshingly simple, almost revolutionary in its common sense. Keep costs low, diversify broadly, and stay the course. This isn't about chasing fleeting trends or trying to outsmart the market. It's about owning a piece of the entire market, letting the immense power of global capitalism work for you. Vanguard champions broad market indexing, a strategy where you invest in funds that track an entire index like the S&P 500 or the total U.S. stock market, rather than trying to pick individual winners. This approach automatically diversifies your investments across hundreds, even thousands of companies, significantly reducing your risk compared to holding just a few individual stocks. But diversification is only half the battle. Vanguard also obsessively focuses on low costs. Every dollar saved in fees is a dollar that stays invested, compounding over decades into substantially larger sums. This relentless dedication to low-cost indexing means more of your money works for you, not for fund managers or brokers. It's a philosophy built on the bedrock of long-term thinking, discipline, and profound simplicity. In this video, I'm going to cut through all the noise, the fear, and the overwhelming options to show you something truly powerful. I'm going to reveal 3 Vanguard ETFs that, when combined, can form the bedrock of an incredibly robust, diversified, and remarkably simple investment portfolio. These aren't obscure, high-risk plays. They're battle-tested, low-cost vehicles designed for maximum efficiency and long-term growth. We're talking about a strategy that requires minimal ongoing management, frees up your precious time, and dramatically reduces your financial anxiety. Imagine a world where you don't need to check stock prices daily, agonize over market corrections, or sift through endless financial news. A world where your money is quietly working for you, building wealth steadily and reliably year after year. This isn't just about saving money on fees, it's about reclaiming your peace of mind and unlocking genuine long-term financial growth without the constant stress. This simplified solution empowers you to take control of your financial future, proving once and for all that less is truly more when it comes to investing your hard-earned money.
Whether it's piling into a popular sector or chasing a stock that's already made huge gains, the crowd often provides a false sense of security. But remember, the herd is often stampeding towards a cliff, and by the time you join, the biggest opportunities have usually vanished, leaving you holding a heavily depreciated bag. Then there's the relentless pursuit of alpha, the desire to beat the market. We're conditioned to believe that with enough research, enough cleverness, we can find that secret sauce, that winning strategy that will propel us past everyone else. This pursuit often stems from ego, a need to prove we're smarter. Yet it almost always leads to constant tinkering, overtrading, and an exhausting, ultimately fruitless quest for superiority. These behavioral biases aren't just theoretical. They come with a very real, tangible price tag that slowly but surely erodes your wealth over time. This is critical. The first and most obvious cost is high fees. Actively managed mutual funds or complex investment products often come with significantly higher expense ratios than simple index funds. That extra 1% or 2% might not sound like much annually, but over decades it compounds into a staggering amount, stealing hundreds of thousands, if not millions, from your retirement. Next, consider the hidden drain of increased taxes. Active trading, fueled by FOMO or the chase for alpha, means frequently buying and selling, triggering short-term capital gains taxes. Each profitable transaction, especially within a year, often triggers short-term capital gains taxed at much higher rates than long-term gains. This constant churn eats away at your capital, preventing your money from compounding tax efficiently. Simplicity, on the other hand, means holding for the long haul, deferring and minimizing those tax events, allowing your money to grow more efficiently. It's a powerful advantage. And finally, there's decision paralysis. When faced with literally thousands of investment options, stocks, bonds, sector funds, alternative investments, complex derivatives, many people simply become overwhelmed by choice. The sheer volume of choices, the endless data to analyze, leads to analysis paralysis. Investors either delay making any decision at all, missing out on crucial compounding time, or they make hasty, often poor choices born out of frustration rather than reasoned analysis. This phenomenon is famously known as the paradox of choice. Psychologist Barry Schwartz highlighted how more options, beyond a certain point, don't lead to greater satisfaction or better outcomes. They lead to anxiety, regret, and ultimately inaction or suboptimal decisions. This applies directly to your investment journey. In investing, this means instead of confidently picking a few broad, diversified funds, people get bogged down, endlessly comparing, fearing they're not picking the best. The best becomes the enemy of the good. The result is often a portfolio that's either needlessly complex, filled with overlapping funds and speculative bets, or worse, an entirely neglected portfolio. The overwhelmed investors simply gave up trying to understand it all. This overcomplication, ironically, often leads to poorer returns and significantly greater stress. But don't just take my word for it. The data, the cold hard facts, consistently tell us a very different story about complexity versus simplicity in markets. For decades, study after study, report after report, from institutions like S&P Dow Jones indices through their SPVA reports, have unequivocally shown that simple, broad market, diversified index funds consistently outperform the vast majority of actively managed funds over the long term. Think about it. Professional fund managers, with teams of analysts, millions in resources, and access to proprietary research, still struggle to beat their benchmarks after fees. This is a crucial insight. Why? Because the market is incredibly efficient. Consistently outsmarting millions of other intelligent participants is virtually impossible. Those high fees and frequent trading activities are significant hurdles they just can't overcome year after year. By simply owning the entire market through low-cost index funds, you automatically capture its returns. You're not trying to beat it, you are joining it wholeheartedly. This strategy bypasses all those behavioral biases, avoids high fees and unnecessary taxes, and completely eliminates decision paralysis for good. It's elegantly simple. It's empirically proven and incredibly powerful. This historical evidence is precisely why focusing on a select few broad market ETFs isn't just a convenience, it's a fundamentally and strategically superior approach. It's how you align your portfolio with decades of financial science, ensuring you achieve robust returns without the stress and hidden costs of overcomplication. These aren't just theories, these are foundational principles backed by empirical data, empowering you to build lasting wealth with confidence and clarity.
You've understood simplicity's power and overcomplication's pitfalls. Now apply these foundational principles. It's time to unveil your core portfolio. I'm unveiling 3 Vanguard ETFs, forming a robust investment strategy. They provide broad diversification, low costs, and a clear path to financial growth. First is the Vanguard Total Stock Market ETF, VTI. It's a powerhouse, offering exposure to virtually the entire U.S. stock market. VTI holds over 3,700 individual stocks, from mega-cap giants like Apple and Microsoft to emerging small-cap companies. Imagine owning a tiny slice of almost every publicly traded U.S. company. You're investing in the entire American economy's growth. This broad diversification significantly reduces single stock risk. Participate in the overall market trend, not relying on single company performance. VTI's expense ratio is incredibly low, just 0.03% annually. That's only $3 in fees for every $10,000 invested each year. Minimal cost preserves more returns, allowing your money to compound effectively for decades. VTI is your foundation for U.S. growth. While VTI covers the U.S., a robust portfolio needs global diversification. Our second fund, VXUS, provides just that. The Vanguard Total International Stock ETF, VXUS, complements VTI, giving you exposure to thousands of companies outside the U.S. Economies are interconnected, but don't always move in lockstep. U.S. markets sometimes lead, other times international markets excel. Holding VXUS hedges against regional downturns, tapping into global growth. It holds over 8,000 stocks from diverse markets. This global reach ensures your portfolio isn't solely dependent on the U.S. economy. It maximizes potential returns and adds stability. Its expense ratio is also remarkably low, at just 0.07% annually. VTI and VXUS capture global stock market growth minimally. For portfolio stability and risk reduction, we introduce our third core fund, the Vanguard Total Bond Market ETF, BND. While stocks target growth, bonds provide stability, income, and act as a crucial ballast during stock market volatility. BND invests in diversified investment-grade U.S. dollar bonds, including treasuries, government agency, and corporate bonds. It holds over 10,000 bonds with varying maturities, offering broad exposure to the U.S. taxable investment-grade bond market. Bonds typically behave differently than stocks. When stocks fall, bonds often hold value or even rise, cushioning your portfolio. BND's expense ratio is incredibly competitive at just 0.035% annually, preserving your bond income. It's an essential layer of safety. So how do these 3 simple ETFs combine into a globally diversified, low-cost, robust investment portfolio? It's elegant. VTI offers comprehensive U.S. stock market exposure. VXUS diversifies you across international markets, tapping global growth. BND provides stability, income, and risk reduction, balancing your equity holdings effectively. The beauty is flexible allocation. Tailor allocation to your risk tolerance and investment horizon. Younger investors might favor more stocks, say 80% equity. Closer to retirement, shift to 60% stocks, 40% bonds, or even 50-50. Core building blocks remain, rebalanced for your goals. This 3-fund portfolio captures tens of thousands of securities globally, providing unparalleled diversification with just 3 ticker symbols. It minimizes fees, maximizes diversification, and removes emotional decision-making that often sabotages investor returns. This is smart investing. This proven strategy builds lasting wealth with confidence and clarity without overcomplication. It offers market returns with minimal effort. Now, let's transform this knowledge into tangible action. It's time to build your simple Vanguard future and stay the course. First, let's set up your foundational 3-fund portfolio.
Step 1. Open a brokerage account with Vanguard. This could be a traditional taxable brokerage account, a Roth IRA, or a traditional IRA, depending on your tax situation and retirement goals. If you're unsure, start with a Roth IRA if you're eligible, as it offers tax-free growth and withdrawals in retirement. Step 2. Fund your account. You can link your bank account and initiate an electronic funds transfer. Begin with whatever amount you're comfortable starting with, even if it's just a few $100s. The key is to start. Step 3. Purchase your 3 ETFs. For example, if you decide on an 80-20 stock-to-bond allocation, you would put 80% of your funds into your chosen total stock market ETF, like VOO or VTI, and 20% into your total bond market ETF, like BND or BNDW. Then add a small international component using VXUS to complete your diversification.
How do you decide on that initial allocation? A common rule of thumb is the 100 minus your age for your stock percentage. So a 30-year-old might aim for 70% stocks and 30% bonds. A 50-year-old might opt for 50% stocks and 50% bonds. This is a guideline, not a strict rule, adjusted based on your personal risk tolerance and time horizon. The younger you are, generally the higher your stock allocation can be, as you have more time to recover from market downturns. Conversely, as you near retirement, a higher bond allocation reduces volatility. Remember, VXUS should typically comprise about 20 to 40% of your total stock allocation to ensure proper international diversification. Once your portfolio is set up, the real magic happens through consistent effort. The second critical step is consistent contributions. Automate your investments. Set up a recurring transfer from your checking account to your Vanguard account every payday. This removes emotion from the equation and ensures you're continuously buying into the market, regardless of whether it's up or down. This practice, known as dollar cost averaging, smooths out your purchase price over time. Next comes periodic rebalancing. Once a year, perhaps around tax season, log into your account. If your stock allocation has grown to 85% due to market appreciation and your target is 80%, you'll sell a small portion of your stocks and buy more bonds to bring it back in line. Conversely, if stocks have dipped, you might sell bonds and buy stocks. This disciplined approach forces you to sell high and buy low without even trying to time the market. Now for the toughest part, overcoming the psychological hurdles. The market will always be noisy. Pundits will predict crashes, gurus will tout the next hot stock, and your friends might brag about their latest speculative win. Your job is to ignore it all. Resist the urge to market time. Countless studies, including those by Vanguard itself, have shown that attempting to market time is a losing game for individual investors. You'll likely miss the best days and erode your returns. Trust the process. Trust the data we've discussed. Trust that owning a diversified slice of the entire global economy through low-cost index funds is a historically proven path to wealth. This isn't about getting rich overnight. It's about consistently capturing market returns over decades. It's about patience, discipline, and unwavering commitment to your simple strategy. Don't let fear or greed derail your long-term plan. Stick to your allocation, keep contributing, and let compounding do its work. You now possess the knowledge and the roadmap to simplify your investing life, reclaim your peace of mind, and build substantial wealth. This isn't just about saving money, it's about taking proactive control of your financial future and leveraging the power of passive investing. Don't let analysis paralysis keep you from acting. The biggest regret investors have isn't starting too late, but not starting at all. This isn't a complex equation, it's a straightforward commitment to financial independence. So here's your call to action. Right after watching this video, open that Vanguard account. Make your first transfer and set up your core 3 ETFs. Then automate your contributions and truly embrace the set it and forget it philosophy. Your financial freedom isn't a distant dream, it's a series of intentional steps starting today. And if you're ready to continue building a life of financial wisdom and clarity, make sure to join our community. Hit that subscribe button and ring the notification bell to ensure you never miss out on practical, actionable insights designed to empower your financial journey.
Your future self will profoundly thank you for taking this decisive step right now.